So today we're going to be looking at spotting market leaders and trading them off of a market low, because that scenario is probably going to present itself in the not so distant future here. Could be sooner than later. Today we had a pretty good day up. I think volume was up a little bit on the NASDAQ. You might want to call it a follow-through day, but I would look for more confirmation than just this one day, but we'll see what the final tally shows. So I'm going to go over some concepts here and try to take you through how stocks bottom, where they bottom, what they look like when they bottom, and, well, actually, I should back up. Really, it's how the market bottoms and how leading stocks emerge. The stocks themselves have bottomed long before the market has bottomed. Usually they're in an uptrend, and sometimes they've already moved out of a first stage or even second stage base. Sometimes you're getting a third stage base that's coming off of a market low. And that might look like, well, that's a late stage stock. Not necessarily. So we're going to go over that today. Now, remember, the grand majority of big winners make their big run starting from a market correction. 96% of the biggest winners in history all came from a market correction. So that tells you, like when I was talking about this a week and 2 weeks ago, saying that this market correction is going to provide a great opportunity, well, there's the statistics right there. That's your big chance. That's your big opportunity to find the next big winner. Now, again, you don't have to have a stock that goes up multi-hundreds of percent or thousands of percent to make big returns. You can trade stocks that go up 20 or 30%, and that's a pretty good move if it's in just a few weeks or a few months, and string a bunch of those together throughout the year, and you'll have a huge return. So it depends on whether you're longer term, but either way, I'm going to buy at the same spot. I'm not changing my entry point. If I'm swing trading, if I'm trying to position into a trade where it's more of an investment, I'm going to try to hold it for a longer period of time. I'm trading at the exact same buy point because that's the optimal buy point. The stock doesn't know how long your time horizon is. When the line of least resistance is formed and the stock moves through it, that's your best opportunity to buy the stock. Okay. Now, the reason why a lot of people mix this up is because a lot of times when you're in a correction, a trader's already made a bunch of mistakes, hasn't maybe cut his losses properly, we're chasing late stage bases and got hurt on the way down, and now is very gun shy when the market starts to show that there's some new leadership propping up. And the other reason is because very often that those new leaders will actually show up before the market gives clear-cut evidence that it's actually bottomed and it's confirmed in a reliable bottoming fashion, if you will, or at least where maybe you're hearing it on the TV and you feel comfortable. By that time, usually most of the leading stocks have already moved out. Now, there's 3 spots at which I look to start buying stocks when the market is correcting. And what happens is you don't know when the actual low is going to happen in the market. Okay, you get a few legs down. Usually it's 2, 3, sometimes more. David always talks about 3 legs down. A lot of times you get 3 legs down. In hindsight, if you take a look, you'll find that it's anywhere between 1 and 3 in your garden variety corrections, and it could be as many as 8 or 10 in something like a situation in the 1920s or even in 2000 going to 2003. It was a lot of legs down. So when you look back and you see where the market actually bottoms and where the stocks emerged, they almost always emerge right around a 3-month period around the low. Now, it can start a few months ahead, 2-3 months ahead, and actually you'll have some that will break out right as the market's coming off the low, and then up to about 3 months later. That's usually your window, your real great window of opportunity. I call it predictive, coincident, and confirming. You can call it leading, coincident, lagging, however you want to term it. But predictive, coincident, and confirming. Now, let me show you the first scenario. This is a predictive. scenario. All right. So this is 2004. This is Apple Computer. Now you can see the market starts going in a correction. And in this particular instance, 1, 2, 3 legs down. That's exactly what happened. You got the David Ryan 3 legs down. This was where the market started coming off the lows and it bottomed. Now, just as the market is topping, you can see Apple is putting in a pretty nice little base here, a little cup with handle, right? Actually, it's a pretty good sized cup with handle, and it's breaking out. But what happens is the market corrects, comes off, and it holds the stock back a bit, so it creates another base. But then when the market comes off of its low after its first few legs down and starts to rally again, stock breaks out again, comes out of another base. Now, like I said before, you don't have to catch this first base. You can catch the very last base, and you've been up 100% from this point. You'd have been up more, of course, if you got it over here. But you can see that this stock, by the time you get to where the market's starting to come off the lows and it's showing some accumulation days, and you're getting to see follow through, and you're seeing all those things that you want to see in the market, we're on the third little base here. All right, you got your third buy point. So the stock has given you a few chances to buy this stock ahead of time. Now, let's take a look at the next scenario. So the next scenario is coincident. Now, usually, almost always, and it depends, of course, the texture of the market. For instance, if you've got a lot of damage, a lot of stocks have been broken fast, it takes time to build, and if the market makes a real V bottom, sometimes what happens is the market bottoms first, and then a bunch of stocks set up in a confirming fashion, and you don't get much off the lows. But usually the market takes a little time to bottom, go back and fill, and when it finally moves off the lows, you'll get almost to the day, you'll get a handful of names that will break out right off the lows, and they'll break out through their pivot points. In many cases, they're moving into new high ground. In this particular instance, you can see this is Humana. Now, of course, Humana, years and years later, this is in 1978. Back in 1978, Humana was a small company nobody knew. But later on, of course, it was a big name that, of course, we've all heard of. At this particular time, it's a small cap company with few eyes on it, and it's breaking out. You can see right off the low. This is the bear market low in 1978, and this stock is breaking out right off the low. And from this point, never turns back, goes up 1,000% in just 38 months. This is the type of timing. This is what you want to look for, this setup. You see this setup and a very tight price action right here coinciding with the low in the market after you've had a big correction. There's another thing to point out here. You see there's an opposite, diametrically opposed picture here. The market is in a long-term downtrend, right? You see, this is a 200-day moving average. See, the 200-day moving average is in a downtrend, and the stock is in an uptrend. You see, so you don't have to be looking for stocks in downtrends when the market's in a downtrend. There's going to be plenty of stocks that are in long-term uptrends and on top of that, the stock's moving into new high ground. So you wouldn't think that would be possible with a market that's down so much in such a pronounced downtrend, but no, these are the leading stocks that are setting up. And this market is just holding the stock back. That's why it's just moving sideways here. See, all the way, if you come back all the way from about August, September, the market goes down more. It keeps falling. But this stock just moves sideways. It's sort of like a spring being held. And once the weight's off, it can move. It can move very quickly. Probably coming out with earnings reports during this period showing, very good numbers, and valuations getting better and better because the stock is not going anywhere, but the fundamentals are improving. All right, so that's a coincident situation, right? All right, so here's a confirming. This is the NASDAQ up here, and this is Netflix. Now, let's break this down because it's pretty interesting. So you get this big decline in the market, right? You have this nice big decline in the market. And you'll see that off this low, that's when Netflix bottoms, and it starts to move up and get into that stage 2 uptrend. But the stock runs up quite a bit, over 100%, and the market makes a new low. But this stock is way off its lows. Now watch what happens. It flips. Now the market starts taking off, and it's moving up and up and up, and everything's looking good on the market. It looks like this indeed was the low, but during that entire markup phase, Netflix just moved sideways, and it's setting up here. This is a confirming setup, and this should definitely not be ignored because, like I said, you're going to get setups that are going to occur for up to 3 months before. That's, of course, if you have a pretty large bear market, but they might be just a few days, a few weeks ahead before the low, right around the low, and then up to several months after the low is made. That's where all your leaders are going to emerge, all around this point right here. All right. So then right here, the stock breaks out. It's up considerably. You know, you might be saying, oh, this is way too high. It's already made a move. It's up huge. And then, of course, Netflix goes up 500, 600, 700% from this point in pretty short order. So those are the three types of setups or the three areas that you're going to look for. Now, of course, that predictive one, you don't really know. All right, you only know in hindsight if the market's actually bottomed. So that's certainly the toughest spot. So as the market's coming down and it might rally off of a few lows, maybe you don't get what you need to see in the market, but a stock sets up really, really well, and you want to try to take a few trades. That's fine. That's fine. But remember, the market has not given you the signs that it's bottomed yet. There's risk there, so you position size accordingly. You take maybe 1 or 2 or 3 trades. You move in maybe 10% of your portfolio up to maybe 25 if things are working, and then if they work from there, you can start adding. You'll find that you'll be adding on the coincident trades, and you'll be adding more on the confirming trades, and then you'll build into the market bottom all around that time. And then when the market really gets going a few months down the road, you're invested. You're fully invested. You're in all leading names, and you might have a few that knock you out, a few more set up, and you'll get yourself you'll jockey for position, and you'll get yourself set ready for the next bull market, and you will be in some key market leaders. And that's the main thing. And the time that you want to hold these names, people always ask, should I hold for the longer term? Should I should I trade or should I hold? I guess that's the hold them. Should I hold them or fold them? Right? That's the big question. Well, when you're in the beginning stages and you've had a correction and you start to move off the lows and you've nailed a few names and you're up on them right away, you want to hold those. You do not want to sell those too quickly because you may have got the next Amazon, the next Google, the next Starbucks right at the perfect moment coming off of a correction. So you don't want to give up that position too easily. Even if you're up really, you have a pretty big gain in it and you feel the stock may be extended short term, that happens when in the beginning of a bull market. What's going to happen is you're going to feel like you're getting a bad price, right? You're going to have to chase these stocks. They run away from you and they get away from you very quickly. It's called a lockout rally. That's the best thing that you can see. The best thing that can happen is that you're having a hard time buying stocks and they're getting away from you and you're getting at a profit very quickly. That's the signal to at least hold some of the position. Maybe you sell half of it, 2/3 of it, you keep a third, something like that. Now, if the market is not very good, it's going to be just the opposite. You're going to feel like you're getting a great price. You're going to have all kinds of opportunities to buy it. Even when it breaks out, it'll come back, pull back to the breakout, give you another chance. And these are the trap trades. These are the ones that let you in the door and then shut it behind you. And they'll put you underwater very, very quickly. And if that's happening, if you take a few of those trades, they're not working and you're getting underwater, you got to pull back. You got to pull back your exposure. Market's not ready. It's not ready. That same trade that's set up, which you thought at that point was coming off the lows. Remember, when you're taking these trades, you're thinking you're trading coincident. It's only in hindsight that you'll find out that you were trading predictive. Right at the moment that you're making the trade, you're thinking the market made its bottom and you're trying to trade off the low. So now you get stopped out of these names. Maybe the market has to go lower, and it's not, that predictive trade's not working. All right. Now, so this is what it's going to look like. And when you set up, when the stock sets up while the market is trying to search for that bottom, on that right side, you want to see those accumulation days. And then when you have these pullbacks, these little pullbacks are going to give you the handles and the pivots and the 3Cs, all the things I talk about, all the vernacular that we discuss for looking at tight pivot areas. These little pullbacks in the market are going to form the basis for that for the most part. So you want to see no distribution in the market during that time. You don't want to see distribution days. That's the worst thing you can see. If you do get distribution in the market, you want to see immediate accumulation come right back. So the worst thing after accumulation is distribution. The best thing is accumulation. So it's basically, it's a lot of jockeying for a position until things really get moving in the right direction and the bull market's really underway. You're really kind of going back and forth sometimes and trying to get in, and then sometimes you'll see, oh, nope, it's not right yet. I got some distribution days. You'll back off, then you'll get some accumulation days, and then things will start hitting, and everything will start running into point very, very, very good if you just stay with that and you don't try to guess and make a big bet and say, well, I think the market's bottom here. You load up, then you get nailed, and now you don't want to go back in, but really it's just a short-term little blip, and you get a few days of distribution, and next thing you know, big follow-through days come in, but you just got hurt and you're scared now. You won't step up to the plate. That's why it's important to be incremental. Don't be greedy. It's not necessary. It's not necessary to get all in at one time, and it's certainly not necessary to pick the market low because most of these stocks don't even bottom at the market low. So this is what it's going to look like, right? So here's an example of a recent stock and a trade we were involved in. Now you can see here a few things. One, here's the market low, right? And right off the low, this is where we're getting the accumulation. There's your follow-through days, right? And then you get that little pullback. And you see how right as you're getting that accumulation, the stock is moving into new high ground and then just pulls back just for a few days, and then it's very hard to buy. That's it. That's your chance to buy it. It pulled back. It gave you one little pullback buy. Then it moves up, earnings, gaps on earnings, and now the pullbacks are very small and just keeps going. And now by the time the market even moves up, a small amount, not even a big move. I don't even know what this is, maybe 10, 15%. The market moves up. You can see the stock moves from, what's this, around $30, $30-something to almost $60. So this is the leverage factor I was talking about. This is how you get leverage. Forget about leverage. This is how you get leverage. Forget about worrying about margin. You won't have to trade on margin if you get the stocks that are moving and making big moves, and you're in the market leaders. You're going to get a natural, or what I would call, or an organic leverage. And then if you leverage that in addition with margin, obviously, you're going to get big, huge profits. But of course, remember, there's always with margin. There's also the downside just is enhanced. But when you get your leverage from a stock that has a huge upside, but you're trading it at a very precise, tight risk, you're getting what I would call net leverage, free leverage, because you're capping your downside and you're having your upside be large. That's something you can't do with margin. Margin, when you increase your upside, you increase your downside. The whole goal is to find stocks at very, very low risk, tight pivot points. Get your timing down so you're timing these things perfect, and then you get your cake and you get to eat it too. You get the big upside with the low risk. All right, so here's another situation that I find interesting. You can see also they're always in a stage 2 uptrend. Always in a stage 2 uptrend first. I don't know how many times I got to keep answering questions in here about stocks that you guys bring up, and I'm not picking on anybody individually, but you bring up these names, and they're in long-term downtrends, and then you want my opinion on them. Well, my opinion's going to be, I'm not going to touch it. So I'm never going to touch stocks in long-term downtrends. Again, just look at history. 99% of every big winner going back to 1889 or 86, whatever it is, the 1880s, all the way back to the 1880s, 99% of every big winner was in a stage 2 uptrend before it made its big move. Now, why would I want to be in the 1% club when I can be in the 99% club? Okay, that's what you have to ask yourself. For your own ego, to pick a bottom and to feel good that you got the low and you didn't pay up for them. It's all nonsense. All right, you have to stick to what works and stick to what history tells you works. All right, so. And you want some evidence that institutions are in there buying the stock. That's what's really important. That's why you want a stage 2 uptrend. You want that inertia. You want that momentum behind the name. Now, you see here the market comes off in 2010. It bottoms right here and starts to run up, and that just bottoms the stock. But then when the market takes this next leg down, a little scary. You're starting to flirt with those lows. I can assure you that a lot of bearishness right here. When you come back down, everybody's saying, oh, we're going to take out the lows. Everybody's scared. Look how tight CMG gets. And look at that. Very, very tight. And then when the market turns up that one day, boom, right out. Right into new high ground. That's the day you should be buying. That's what specific entry point analysis is about. It's finding that one day right there. And that's the day you should be buying. Now, if that doesn't work, and you buy this stock and it comes crashing down a few days later and you get stopped out, well, that tells you very simply that the market is no good, because there can only be one of two things that can be wrong. One, your selection criteria is faulty, or two, the market's hostile. So if you have this perfect selection criteria, you've got this beautiful entry point, you time it perfectly under perfect conditions with the chart pattern tightening up just right off the market lows, and it doesn't work, well, it's not the stock setup. You dotted all your I's and crossed all your T's, so you can narrow it down that the market still has some work to do. All right, so here's CMG. All right, I'm going to just zoom in a little bit here if I can. Let's see. Yeah. So you can see, again, you see how once it breaks out here, very hard to buy. You see how it moves up and the pullbacks are very small, and it doesn't give you much of a chance to get on board. And then just like that lumber liquidators, earnings come out, gaps up on the earnings. That's because all this time that this stock is holding up while the market's correcting, it's discounting. It's discounting good earnings. It's setting up. Its valuation is improving because the earnings are and the fundamentals are getting better as the market is holding it back, and that is making it cheaper because it's not moving up with the earnings. So then finally when the earnings come out, the stock plays catch up and really starts to run up. And this was just the beginning of course, a very large move for this stock. And then I showed you earlier, this was the WR Grace, a trade that I did really well on because it moved up so quickly and I stayed with it. You see how very tight, it's so tight, in the chart, you can't really see the detail of it, but right off the low, see as we're correcting here, the stock's moving sideways. It's going through these tightenings, right? Let's zoom up. See the tightenings? 1, 2, 3, 4. On that fourth T, it gets very tight. And then look at the volume. See how the volume really just dries up here. And then as the stock comes out, look at the volume. You see, you can't hide that. That's big contrast. And look where it's coming. It's coming right as the market starts coming off the lows. Now, this is a leader. This stock went up 55% in 55 days. Now, right around that exact same time, that was, what was that, 2004. Right around that same time, September 04, look at this little guy who's coming off of a nice little low pivot here. You may have heard of it, Google, right? And look how it comes out of the pivot point right here. Okay, these don't have to be at new highs. Okay, you can use the 3C, you can use the low cheat, you can use all the different entry points that I've shown you. You want to get it somewhere coming up that right side as the stock's bottoming. And this, of course, we go through this extensively. This is a chart from the Master Trader program. But look, the thing that's really important here is to see look at how it's so hard to buy. And then it never sets up a right side, has a little natural reaction, tennis ball action. See, very hard to buy again. So the pullbacks are almost non-existent. They're just a few days, and the stock keeps going. And I believe, just like lumber liquidators, just like CMG, I'm pretty sure this was earnings, gaps up on the earnings, same situation. See, up 7 days in a row. Once you hit, now this is why you have to look for these buy points. They happen in 1 day. They happen in 1 day. Now, if you miss this one, and this is what happens, people see it in hindsight. You know, they maybe were watching it, but were scared to buy it there, and then it runs up, and they go, oh, man, that was perfect. That was perfect. I wish I bought it. Now they want to buy it up here. That's not advisable. You don't know if this is going to take place and it's going to keep moving higher. You want to buy it at the perfect buy point. If you miss the perfect buy point, wait for another one. Wait for a secondary buy point to set up. Sometimes you get a second base. You get a base on top of a base. You get a pullback to the breakout. You get a pullback buy setup. There's going to be all kinds of chances, okay? Don't let fear motivate you. That's the key in stock trading. Don't let fear motivate you. Here's how fear motivates you. You want to buy something. You don't buy it because you're fearful that you're going to make a mistake. It's going to be a loss. So then you talk yourself into buying it, and the thing goes down, and you don't sell it because you're afraid you're going to sell it, and it's going to go back up and make a monkey out of you. But the same situation happens on the other side. You buy the stock perfect. It takes off. You're up on it, right? Now you have the fear on the other side. You don't want to sell it because you're afraid it's going to go higher. I mean, it'll just never stop. The fear cycle and the fear paralysis happens on every angle if you allow it to take hold of you and operate from being motivated by fear. You have to change the way you look at things and go in with a plan and execute that plan and take your position sizing accordingly, where you're not taking a huge risk and you're so worried and scared, and you got to get away from your ego. All right, this isn't about being right. It's about making money. So you're going to be wrong. You're going to be wrong just as many times as you're right, but you're going to have a plan to deal with when you're wrong, and you're going to deal with it very, very quickly and effectively, and not Monday morning quarterback. If you sell the stock and it's at your stop loss, it turns around, it goes back up. That's the cost of business. It doesn't mean you're a dummy. It doesn't mean that you made a mistake. Taking a loss where you went into the trade with a plan that's not a mistake. Okay. Now you'll look to see if maybe you can get back on board that name. If not, you'll look for another name. There's going to be thousands and thousands and thousands of stocks that are going to make huge moves, and they're going to be there long after you're gone. So there's going to be no shortage of stock ideas, I promise you. So now, once you buy from these buy points, and particularly you're buying, if you see follow through in the market, and you're buying right around that time, you should see a few days of follow through buying in the stock. If you don't see it, you want to see quiet action subsequent to the breakout. So for instance, maybe it breaks out for a day, then pulls back or goes inside for a day or two. That's okay. Sometimes even it breaks out and it squats that day, and it can't really come out all the way on the follow through day in the market, but you should get a reversal recovery in a few days, certainly within a week or two. So you're always looking to see if things are natural or if they're unnatural. So you're looking for tennis ball action. The key is to always look for tennis balls. The stock breaks out. It's okay if you let it pull back a little bit. Watch it. Take a look at the volume. See if it's resilient. If it's not, and it can't move, and it keeps moving down, and it's getting you at a loss, and it's starting to hit violations, and you start trimming your position back, and it means you got to rotate into something else. This is work. Okay, I know some of you don't want to have to go in and out and jockey for position and scale up and scale down, but I'm sorry to tell you, it takes work to make a lot of money in the stock market. It's work, and it takes a lot of attentiveness. There's no free lunch here, because there's lots of people out there that are willing to work very hard, so they're not going to give it to people who are lazy. All right, so let's take a look here. This is a stock that I traded, Baby Stores, and you'll see that we come through very tight. See how the pivot's very tight? And again, 1, 2, 3, 4 tightenings. See how it's getting, this is the towel. Remember I talked about the towel today? So this is the first time they twist the towel, they get some water out of it, rallies back. Second time, a little less water, or supply, what I'm calling water. Next time, and then finally you get, this is what I'm looking for. Right here is what I'm looking for, that nice tight price action little inside day. Now, watch what happens. It breaks out. And this is coming, mind you, remember, this is 1998. This is October of 98. This is after we had the big 500 point decline, the one-day decline on a Monday, which I happened to forecast on the Friday before on the Neil Cavuto show. Anyway, so very shortly after that, the market bottomed. And this is one of the very first stocks to move up off the lows. You got a primary base. It was a new issue. It corrected, set up perfectly. And now you see how you break out one day, and 4 days, you're up 3 out of 4 days. And the third day, you go inside. You're up 3 out of 4 days. And the third day, you go inside. That's that inside day we were talking about. That's another good spot to see an inside day. When you run up a few days and then you just go inside and see, look at the volume. Look at how low. I want to show you something here. Do you see how low that volume is right here? Right around the time where it tightens up right here? That's a tip-off in itself. I mean, you could have been buying it right here as it turned up there. And then when it finally comes out here and really explodes, the volume really picks up, and then on that third day, you see how the volume comes way in. You see that I'm looking for contrast. When stocks are under accumulation like this and they're ready to move through the line of least resistance, you're going to see big contrast. Don't discount volume. You got to look at volume. I know a lot of people say, oh, well, does volume work anymore? Dark pools, all that. That's all bull. Yes, it works. It works perfectly fine. All the volume's tallied at the end of the day anyway, and you're going to see it in these end-of-the-day charts. So you're still going to see expansions in volume intraday too. So you definitely got to look at volume. Volume and price have to be related together. And when you start putting these together, you're going to really improve your probabilities of success. But on top of that, you still got fundamentals that you can use. Now, once you have an understanding of what type of situation you're dealing with, then you can look at the fundamentals and see if they make sense. This is a turnaround situation. Okay, well then they're going against easy comps. Then I got to see huge quarters in the most recent few quarters. So that gives you even added. I don't like to use the word safety, but an added probability that stock's going to work if you do your analysis correctly. Now, you see we run up here, and now look how hard this stock is to buy. It runs up, it pulls back, 4-day natural reaction, tennis ball action, right back into new highs. Pulls in for 1 day, closes way up at the top, can't give anything up at all. Then it just drifts back, undercuts a previous low, little shakeout, creates a little tiny, look at a little, even you're getting VCP even here, little mini 3C. Tightens up right there. That's a perfect spot to add to it. When you're at the beginning of a bull market, you can add on follow-up buy points. You want to pyramid into these names. That's how O'Neill made a fortune. O'Neill, some of the Amgen was one of them actually. Amgen, he kept buying and buying at higher prices. Apple Computer, he did it. He did it with Pick and Save back in the 50s or 60s. By coming in at the beginning of a bull market and building a big position in a market leader that's working, you can make a fortune, and that's how you do it. All right, so you see pullbacks. Now, at some point, this is going to get unnatural. You're going to see these pullbacks that have been very orderly. All of a sudden, there's going to be a big break in the stock, and or the stock will get way ahead of itself and it'll run up, and you can take a little off the table and trade around the position, or maybe even take your whole profit. That's of course, that's a whole nother tutorial. So once you buy these names, I'm not going to get into the violations today, but we can do it another time. And like I said earlier today, this is going to be in my new book. We're going to talk about all the violations with examples of the violations, all charts to mark them up and show examples. But once you come out of these bases, you don't want to see a close below the 20-day. Your odds of success if you close below the 20-day after a proper breakout from a proper base. Now, those are pretty big words, though. Proper breakout, proper base. So that has to be done correctly. Then the probability lowers if you're closed below the 20-day. So if you're coming out of a perfect base and then the stock turns around, closes below the 20, your probability of success cuts in half. Okay, if it was X, it's now half of X. Now, the next thing you want to look for is how many consecutive down days. Because when a stock breaks out and it's under accumulation, it's very likely that the institutions that are piling into that name That's when you see that big volume. That's because there's institutions coming into that name, not Aunt Betty and Uncle Sam. Those are big firms buying big blocks, and that's what you want to see. They will add to their position. They're building a position. They don't get in on one day. So when you get one big breakout day, that doesn't get everybody in. That usually means they tried to get a big piece, and they moved the stock, and it really started exacerbating itself because there was no supply. The supply had dried up. Like, of course, that's the reason why you look for the VCP, and they had to back off. Now, if the stock comes in, they should support it. You should see supportive action on the second, third day. So if you start getting 3-4 days lower lows and it can't rally, that's a red flag, and then you have to start watching it a little more carefully. That very often will happen before it gets below the 20, and then it'll close below the 20, and then you'll see maybe some wide price action. The volatility will increase. If you get increased volatility and you start having outside days and big wide moves, maybe it still hasn't hit your stop yet, but it's starting to act like a bucking bronco. That's another strike. That's another violation. Now, mind you, this is only right after you purchase the stock and it's come out of a base. And then if that breakout is on low volume, so it does break out of the base, but the volume is very low. So it's saying below 30 or 40% above average daily volume. I'd like to see more. I'd like to see 100%, 200%. But if it's below 30%, and then maybe a day or two or a few days later, it comes back in the base and the volume's even higher, that's another strike. So you'll find that these will add up, and they'll start piling up a lot of times before you ever even get to your stop loss, and this will give you an indication that to reduce your position. So here's a perfect example. I'm not going to as much look at the volume in it as I'm going to look at the price action here. This was Coors, and the reason why I want to show you this is because this shows how quickly a stock can metamorphose from a long to a short. Not to just getting out of the trade, but to actually giving you a short sale candidate. So here we have a base setting up here, right? And you get this 3C setup, and then it tries to come out here, and that was right before earnings, if you remember this. And then earnings come out, and the stock gets volatile. So now you've got those few little strikes, right? The stock broke out, it's not following through, and you're getting volatility. So that's a warning sign. Then it tightens up, and it looks like, okay, maybe it's okay, and it tries to turn up again. You see another little breakout attempt, but it can't even get out. It can't even get above the pivot, and now you start getting lower lows, 1, 2, 3 lower lows, and the volume starts coming in on the downside. You're breaking the pivot. See, everything's going wrong here. It's all going in the wrong direction, and now after that, it can't rally. It can't rally. It just moves sideways, and it puts in the ledge. We talked about this morning, right? And that's where the short starts setting up. Now it breaks down. It gets below the 200, and this is where I talked about going short. I came in the room intraday that day and said if we close below the 200, this is probably a short. And this stock topped huge right from this point on. So that's just, if you can get this in your mind of what you need to see for the stock to break out, basically, here's what you need. You need, 1, what you need to see to buy the stock, right? 2, you need to know what you need to see to hold the stock. And then 3, what you need to see to sell the stock. So there's 2 ways of selling, at a profit and at a loss. You need to have a plan for all of those. A plan for buying, a plan for holding, and a plan for selling. And selling into strength and selling into weakness. That's your whole stock plan right there. That's the whole stock plan. That's what you have to work on. Having a pre-decided decision-making process for how to deal with the eventualities that are going to happen under those 3 scenarios. When I see this, I buy. If I don't see this, I hold. If I see this, I sell. That's what you have to think about and get that into your repertoire, if you will. So when you're going into these stocks, right, you're gonna of course you got to start with 1. So maybe you see a stock set up, it looks like the market might be bottoming, you take a trade, you take 2 trades, they're holding up pretty good. What you want to see is a proliferation of setups. You don't even need to see stocks breaking out all over the place just yet, but you want to see them setting up. If you don't see stock setups, then there's not even merchandise on the shelves. You go into a store and there's no merchandise on the shelves. You don't go out to the car and go, "Hey kids, wife, come on in, let's go shopping." You know, bring the credit cards. There's nothing on the shelves. You can't shop. So you have to see merchandise setting up. Just think of it as, you know, you're a shopper and you're looking for merchandise and you're looking for really nice merchandise. You want Tiffany cufflinks here. So you're looking for the best merchandise, and that's the first thing. Then you're going to take a few trades. You're going to test the water with your toe. You're going to put a few trades into your portfolio. You want to see some things working. And right around that same time, you want to see signs of accumulation in the major averages with no distribution. And if there is distribution, you want your stocks to hold up. So let's just say you get a distribution day. If no stock really acts poorly and a few more set up, all right, you can give it a few more days. Let me see. Maybe we're going to get an accumulation day. You know, it's going to come ripping right back in here. I haven't had any pressure on my portfolio. Great. You're bending with the market. You're bending with your stocks. You're not arguing with it. What you don't want to see is the number of stocks diminishing. You know, you take a few trades and you got losses right away. And there's not many stocks setting up, or there were stocks setting up and now they're falling apart. And then, of course, signs of distribution in the averages. So maybe you get an accumulation day, but right away distribution, no accumulation, and things are starting to fall apart. You're obviously early, so you're going to back off. Let's see. Okay, so here's what we want to look for. All right, you want to do your homework. The main key here is to do your homework while the market is down. If you prepare while the market's down, you will be in position to take advantage of when the market turns up. But if you wait until things look good, you know, this is what happens. People do this all the time. They say, well, you know, I'm not going to join Mark Minervini's service until I see the market's bottom. And because, you know, I know he's a leading stock kind of guy. And, you know, when the market's good, you know, I'll go. By then, if they're all gone, you know, you need to see all this ahead of time and set up for all that. It'd be better to say, you know, I'll join his service when, you know, the market's in correction. That'd probably be you know, if you're going to time it, that's probably the best time to start it. But any time is a good time to get started. But the thing is that you have to get yourself in sync with the market. So you wait and you get in sync, and at some point the market will sync up with your analysis, and that'll be your starting point to get into the market in earnest. Now, so when the market's coming off the low, here's what you want to look at. You want to start looking at the 52-week high list. Okay, these are stocks that are breaking into the new high list right as the market's coming off the new low. That's telling you, I'm strong here. Hey, take a look at me. Stocks that corrected the least amount when the market was declining, and still trading within, I'd like to see it within 10 or 15% of its 52-week high, but no more than 25% of a 52-week high. The closer, the better. So preferably very close to the new high. So if you have a stock that is moved sideways and corrected, let's just say 12% from peak to trough, and it's moved sideways for 8 weeks. During that time, there's been an 8-week correction in the market. The market starts to move off its lows. And this stock and let's just say the market's down 18% during that period. The S&P's down 18%. The S&P's down 18%, and this stock didn't even come off 12%. Most stocks correct 1.5 to 3.5 times the general market. This stock corrected less than the general market, and now right off the low, moving into new high ground. That in itself, you almost even have to look at the fundamentals. That right in itself, right there, you should be buying that stock if it's coming out of a base. All right, stocks that surge in price off the market low, the largest percentage movers. Remember I showed you Netflix? Netflix off the low went up 125% on that first leg up. That's a gigantic move. The market made a new low in the same time. The time that the market made a new low, Netflix went up 125%. That should get your attention. That's telling you that's a stock, once again, saying, hey, take a look at me. Something's going on here. I wouldn't be doing this if something good wasn't going on. Excuse me. Accumulation in the major averages at around the time that these leaders start breaking out. 1 second, please. Sorry about that. Right around the time these stocks are breaking out, like I said, the accumulation of the major average and a proliferation of stocks that start setting up and then emerging through the buy points. By the time they're moving through the buy points, I hope you're buying them. I hope that at that point, you've been watching them set up, and you're placing your orders. All right, now let's take a look here. This is another stock, and I try to only show, I can't always, but 90% of the time, any stock that I'm showing you guys, like in my book, most examples, 90% of the examples, the Master Trader Program, they're all stocks that I traded at this particular time. This isn't hindsight. I'm not looking back, let me find something that looks really good that makes my point. When I was trading these, not only did I not have the foresight, the benefit of hindsight, but on top of it, I wasn't even that good. I got to tell you, like in 1991, I wouldn't consider myself an accomplished stock trader. I had only been in the stock market for about 7 years at that point. In the prior 5 or 6, I lost money. So I just started to really make money in 1989 and the 1990 bull market. This is where I really started to get it, where I initially knew what I was doing. Let's just put it that way. I started to know what I was doing. And here's a name where I started to be smart enough at this point to start paying attention to market leaders, because prior to that point, I was buying stocks after I wait for the market to bottom and look for strong groups and then find the best stocks in the group. Meanwhile, the market leaders were long gone, months and months and hundreds of percents ago. I was never picking the market leaders. So I said, what is going on here? How do I keep missing these key stocks? Because then I'd go look back and I'd see this perfect base that came out. I go, how did I not see that? Because I wasn't focused on it. I wasn't focused on the right thing at the right time. So I changed all that in 89 and definitely in 1991. During the 1990 bear market, all I did was prepare. I just sat there every day and said, I'm not going to short. I'm not going to do anything. I'm just going to wait for the stocks to set up, and I'm catching them off this low. I'm not missing it this time. And this was one name that it was actually a confirming name. I'll show you another name that I bought that was leading. This was a confirming name. It happened after the market had already bottomed. So right here, at this point right here, the market is down 23% off its high. And this is where we bottom, right here. This is where the bear market started. You can see the stock tops right where the bear market tops. Right where the market tops, it tops. But then it tries to move a new high ground, which was a little bit of a tell in itself, okay? I mean, when we get over here into September, going to October, this was a really scary time. The market was really looking bad and was down considerably. But finally, the market weight, the stock just couldn't handle the market weight, and it pulled it, dragged it down to where it actually bottomed after the market bottomed. But I watched it because it was starting to build this nice little trough here, and as it came up this right side here, I started getting really excited. And this may look tight right here, but see, like right there, look how tight it gets right there, and that's where I got a green light. That's where I got really, really excited. And you see the volume. I don't know if you can see this. Let me zoom up on this. This is good too, because I know some of you saw this in the Master Trader Program. This is a chart, and it might have been tough to see, but we can zoom up on it here. See right here, as we tighten up right there, look at the volume. Look how it goes down that one day, how low. And even those other days are very low. And then look at the contrast. See the breakout? Very good net price progress and huge volume coming in. And that's where the stock takes off. Right from there, boom, it's out of the gate. And that was a confirming. That was after the market had already bottomed. So let me show you here where that is. That's right. This is the Dow. So you see the market bottoms here, but then it sets up this little 3C, if you will, and then coming out of it, that's where this market leader comes right out, right with the market up the right side. Now, let's take a look at another one. All right, so this is Amgen. Now, I had bought U.S. Surgical, Ballard Medical Products, U.S. Healthcare, Healthcare Compare, a whole bunch of stocks I started buying as they were breaking out. Now, and this was before the market really started to turn up. The market bottomed right here, and then we started getting accumulation days and the market started turning up off its lows. But what I noticed was that many of these names, they weren't even going below their 50-day by much. Now, at this point right here, you have to imagine the stock market itself is below its 200-day moving average. It's in a downtrend. Everybody and their grandmother's calling for the smartest people in the business, Ned Davis, Marty Zwag, all the newsletter writers, all the hedge fund guys are all calling for a 1970s style bear market. Pessimism is rampant. And meanwhile, I see Amgen, U.S. Surgical, like I said, Ballard Medical Products, all these healthcare and medical names that the market correction could barely take them below their 50-day moving average. And then right as soon as the market turned up, they're all breaking out. I said, this is just, something's going on here. There's just too many names in this group breaking out. So I bought a few. One of the early ones was Amgen and U.S. Surgical. And this turned out to be huge winners. But let me show you where that is. So, okay, so there's Amgen. See, so here's where I'm buying Amgen. Here's where I'm buying Elan. You see, I'm building in my positions right off the low. Now, if you go back and you look at my portfolio, by the time I get up this right side right here, I'm invested. I got all my money in the market. I look like I'm a market timer. I'm a genius market timer. I bought right off the low, and I pyramided right up the right side before a giant bull market. I didn't even look at the market. All I did was look at the stocks. It's going to be the same way every time. You just look at the stocks. If you're following the leaders when the market's correcting and you start buying them as they break out, you're going to look back, you're going to overlay your purchases over a chart of the Dow or the NASDAQ, and you're going to find you're an impeccable market timer. That's the way it will work if you allow it to work and you don't force trades. You have to let the trades come to you. You have to be patient. You have to let these trades set up properly and stick to the rules. Now, that's the hard part. All this is great, and I make a lot of sense, and I'm sure I'm confident enough and have enough success to make a believer out of you. But what you really have to believe in is yourself, and you have to follow rules. You got to come up with rules. You got to follow the rules I give you. Come up with rules for yourself that you feel work for you, and you got to be disciplined. And you can't be a Monday morning quarterbacker and think, the stock went up. I knew I should have bought it. And if I broke the rule there, I'd be in it. I would have made a ton of money. Okay, yeah, well, not one time. And there's times where you would have lost a ton of money too. It's all about consistency. It's about being repeatable. You have to be able to do this over and over. You're not going to just make one trade. This isn't going to end in just a few trades or one cycle. It's going to take you several cycles, bull markets, to make a lot of money. And if you're doing really well and you're making a lot of money in those cycles, you're not going to want to quit. I can tell you right now. You're going to want to keep doing this. So you're going to be doing this for a long time. So you have to have something that's consistent. That's the only thing that separates a pro from an amateur, consistency. I could walk on the basketball court right now, throw a basketball in my hand, and I'll hit some three-pointers. And I might even get a little streak, and I might go, probably not, but I might go, 7 for 10 at some point. But could I do it all the time? Could I do it consistently? Can I maintain that number? Not to mention under pressure in a situation where there's a defender in my face and there's professional basketball players guarding me. No, I can't. That's why Michael Jordan's Michael Jordan. So it has to be consistent. You have to be able to do it over and over, and that's what you have to focus on. And some people just don't get it. They're going to continue to say, well, I saw this stock, when it was down, and if I bought it when it was in a downtrend, I would have made a ton of money. By the time it even got in an uptrend, it tripled. Okay, fine. But let me know how many millions you make from that and how duplicatable it is, and then write a book, and maybe we'll look at that strategy. So anyway, I got to go now. I think we had a pretty good session here. It's been about an hour. I think this really flushes out what to look for here. I mean, I can go on for hours and hours and hours, and I bring David Ryan in here. We could go on for days. So, but I'm really gotten good at bringing what's important to people now. That's really what this whole thing is about, is having you focus on what's really important. There's a lot of other things that you need to know, and you'll learn from experience, and you'll learn from, over time with me. But these are the things that are really the key things. It's 95% of the whole battle are the things that I'm bringing to you, and really crystallizing it. This is crystallizing this stuff for you. So I hope this has been helpful. When we get this downtime, we get time to do things like this and have some study sessions that are enlightening, and so there's a silver lining to it with that as well. Again, I have no idea where the market's going here, but I know there's not many stocks setting up right now, so we'll keep watching. What I will say is that I've seen markets where there's no stocks. It looks like there can be no stocks for 2 months, and then a week later there's a ton of them. So I never ever say, oh, I know, there's going to be no stock setting up. I never say that because I never know. I really never know. And I've been doing this for 31 years, going on 32 years next year, and I still don't know. I have to watch, and I have to be a caboose, and I have to let the market be the engine. All right. So thank you, everybody. Monitor the platform. We'll see. Take it day by day. Let's take a look, see what happens tomorrow. We continue to run screens and see if we can find anything that's setting up in this market, and we'll just take it day by day here and watch carefully for these setups to start emerging here. Okay. All right. You're welcome, everyone. I'll talk to you guys soon. Take care. Have a good rest of the night. Bye bye.